Hello, and welcome. Welcome to the next episode of The Wealth Shepherd. I am your host, Ed Gwinnell, president of Gwinnell Wealth Management. And today we've got another great topic for you that we're going to jump into here right away. And I call this one Taxes and the Power of When. And I'm going to dig into that title a little bit here in just a few minutes. But let me start out by just reminding everyone as we go through the show, or if you've watched past shows and you have questions, you can always reach out and give me a call at 916-359-2750. Again, that's 916-359-2750. You can always visit the website, www.edgwealth.com, and you can click on the resources tab to watch old episodes, previous episodes, and current episodes coming up. Just click on the resources tab and click on that podcast button, and all the shows will be right there for you. Excuse me. And so we're going to go ahead and jump right in. You can also listen to the show on our YouTube page. We've got our channel, The Wealth Shepherd, on YouTube. We're on all the different podcast streamers, Amazon, Apple, you name it, we're there. So let's just jump right in here and talk about taxes and the power of when. The first thing I want to do is start out with a little question for you here. The question I want to ask you is, do you think taxes are going to be higher or lower 10 years from now? Now hold that thought, because your answer should really completely change how we save for retirement. And as we get into this topic of taxes and the power of when, what we're going to talk about is how we can control the amount of taxes we pay to some degree in retirement. And as a financial advisor, I always tell our clients that the three largest risks to your retirement are going to be taxes, inflation, and rising healthcare costs. Now, we can't control a lot of that. We can't control inflation. We can't control rising healthcare costs. We can control to a certain degree when we pay taxes, maybe not so much if we pay taxes, but when we pay taxes, which I think is equally important. So by the end of the episode, we're going to talk about, and you're going to understand how the three tax buckets for every dollar you save, how those dollars fall into those buckets, and then which one is quietly costing people the most money. Okay, so let's go ahead and get into this segment a little bit about why this matters right now. As we know, taxes are very, very, very important, and taxes are really correlated to government spending. Now, I happen to live in California, and in California, our government tends to overspend on a lot of things, and the way that they recover that revenue is how? More taxes, right? They keep taxing us. They keep adding new taxes to bring in that revenue to try to shore up some of that spending. And so this isn't really about which party is in power. This really has to do with when the government spends more, it eventually is going to need more. And when we look at tax rates from a historical pattern, the top tax rates have moved a lot over the last century, let's say. And they've moved up almost every time the government needed money. If you look at things like World War I, World War II, the Korean War, Vietnam, these types of events tend to drive where taxes are going in the short term. In 2017, we had a very unique opportunity, right? The Tax Cuts and Jobs Act was passed. It lowered our tax brackets. And so it gave us a great opportunity to really do some significant tax planning for people. And what happened was we knew that taxes were going to be lower up to 2026. And then the current administration extended those tax cuts to at least 2030. So we've got a great opportunity to really try to address these taxes in retirement. So when I ask, do you think taxes are going up or down? I'm not trying to scare you. Really what I'm asking you is, I'm asking you to plan for that answer that most people already believe and know, which is taxes are likely going to be higher. Now, let's say that the income tax brackets may not necessarily be higher. However, other taxes that get thrown into the mix are going to bring all of our taxes up together. So, this really boils down to government spending. Look at where the government is spending their money, and then where do you think taxes are going in the future? So when we think about taxes and the possibility that taxes are going to be higher in the future, and then we start to look at our retirement window? What does that look like for us? Where's our income sources going to be? And then how do the three tax buckets come into play? So let's talk about this from the standpoint of, every dollar that we save for retirement falls into one of three buckets. And most people are only using one or two of these buckets. So these three different buckets, I think, help you to diversify not just your income, but also how and when you pay taxes on that income in retirement. So the first bucket we're going to talk about is what we call taxed now. Okay, these are the accounts like your brokerage accounts, your bank CDs, non-retirement savings. You've already paid taxes on this money. You're investing this money, and now you're basically paying tax on the growth. It could be in the form of dividends, interest, or capital gains. And then, of course, those capital gains taxes are important to manage as well. The difference between short-term capital gains and long-term capital gains. What triggers a capital gain? It's when you sell an asset that you've owned. If you, let's say it's a stock, okay, you have a portfolio of stocks, the water heater went out, you need $10,000, $15,000 to replace the water heater, so you sell some stocks. If you've owned those stocks for less than a year, then they're going to be taxed as short-term capital gains, which is ordinary income taxes. It's going to be just like if you received a paycheck. You're going to pay taxes the exact same way. However, if you've owned those assets for longer than a year, then it's taxed as long-term capital gains. And typically, your long-term capital gains rate is going to be much lower than your income tax rate. Okay, so that's taxed now. The next bucket is taxed later, or what we call tax deferred. Okay, these are things like your 401ks, your IRAs, 403bs, maybe you have a 457 plan. This is money that you're contributing pre-tax. You have not yet paid the tax on it. Every dollar that you put in for retirement is going to grow tax deferred, meaning there's no taxes paid on the growth. However, when you pull that money out, you're going to pay the taxes on those distributions. Okay, so that's tax deferred. So you're not necessarily avoiding the tax. You're kind of postponing that tax into an unknown future as to where taxes might be down the road. The last bucket is our tax-free bucket. So this bucket is things like your Roth IRAs. It could come from certain types of life insurance strategies. You pay the taxes up front when you make the contributions. The money grows tax deferred, so you're not paying taxes on the growth. And when you pull that money out, it comes out tax-free. This is where the power of when, which is choosing which bucket and when you pay the tax bill, really comes into play. It's not whether you're going to pay it, but when. We call this also the sequence of distributions, meaning you choose which buckets you pull from in retirement to help maximize your tax efficiency. So we really want to try to make the case for spreading your money across all three buckets. And the reason is one, you have more flexibility and control, right? You get to choose which bucket to pull from each year so that you manage your tax brackets. The second thing is you get a lot of protection against future tax hikes when, if rates go up, your tax-free bucket doesn't really care because you're able to pull money from that portion. And also in retirement planning, it's going to help you with guaranteeing that for sure income that isn't at the mercy of tax laws or even the market, right? We want to make sure that our income is steady, at least, if not growing. And one of the things I always try to encourage people to understand is in order to retire, you have to have income. In order to stay retired, you have to have consistent, stable income. And that comes from managing these three different buckets. And I always tell people you can make more money saving on taxes than you can by making more money. Think about that for a moment. Every dollar that we earn is a dollar taxed. However, every dollar that we save from taxes is a dollar back into our pocket. So managing those tax buckets, hugely important. The next thing I want to talk about with you for a moment is some actual real life examples of someone who's managing their tax buckets. Okay, we're gonna use Jenny as an example. Okay, this is an actual client, but we're gonna change her name, obviously. And what Jenny was looking at was, she was getting ready to retire, And she had several years before she was going to have to start taking money out of her retirement accounts. And her concern was, what happens if tax rates go up and I put this money off and it grows and then I've got to take distributions? I'm going to be paying more in taxes over time. And as I mentioned, the 2017 tax cuts gave us an opportunity to do some planning. So one of the things that Jenny was able to do was to put together a Roth conversion strategy. So this is where we take that taxed later bucket or the tax deferred bucket and we convert that to a tax-free bucket. Okay, so let me kind of walk you through the scenario here. So Jenny's 40. She saves $5,000 a year pre-tax for 25 years. Let's say she's in a 15% tax bracket and she's earning 6% on her money. Very conservative. Okay. By age 65, she'll build up about $290,000 in her retirement account. And she wants to start drawing it down at about age 70. And she knows she's going to need that money for, let's say 20 years. So here's where it really gets interesting. If Jenny does nothing and she just allows her money to grow, by age 70, it'll grow to about, say, $389,000, $390,000. Let's say she withdraws about $32,500 a year, but now she's in a 25% tax bracket. That's going to net her about $24,000 a year. So over 20 years, Jenny pays about $160,000 in taxes and nets out about $480,000 in actual spendable income. Now, option two is she pays the conversion taxes at her 15% tax rate. Okay, so that's about $58,000 total paid from the account itself. The account settles around $330,000 by her age 70, but now every dollar that she pulls out is tax-free. And I think you can see kind of where we're going with this is, what would you rather do? Pay taxes on money at an unknown rate down the road, or control when you pay those taxes at a rate that you know and are comfortable with and that you can manage? So over 20 years, Jen's going to net about $544,000 in spendable income through retirement. So the same savings habit here, right? Same rate of return. The only difference is when she paid the taxes, and that's about a $64,000 swing in what she actually got to keep and what she got to spend. And that's the power of when in real dollars. Okay. The next thing worth knowing and understanding here is, it surprises people when assets are transferred from one type of an account to their beneficiaries. When you transfer an IRA account to the beneficiaries, you're also passing them a tax bill. And a lot of times the tax planning we do in advance may not necessarily benefit us in the long run, but it could benefit your beneficiaries, your kids, your grandkids, right? And I think, if you think about this from the standpoint of controlling your taxes, the power of when you can address those taxes up front, not only can you put yourself in a better, stronger position by creating more tax-free income in retirement, you can also put your kids and your grandkids in a better tax position, which I think is always important to try to do. But there's also when you transfer those taxed now assets. So when you transfer those tax now assets, things like your brokerage accounts, maybe you have real estate, other assets of high value, you're passing that on in what's called the step up in basis. Okay, so what that means is, let's say, for example, I buy stocks for $100,000 over the years. And over the years, those stocks grow to about $500,000. The $100,000 is my cost basis. If I sell those stocks, obviously, I'm going to have a capital gain. And I'm going to end up paying taxes on the sale of those stocks. However, let's say I pass that on to my kids. Under current law, if you pass this on to your kids, they get to inherit it at the stepped up basis. So their cost basis is not $100,000, it's $500,000. So they get to inherit that money without paying any taxes on that. Now, if Congress changes the rules and they put those step up in basis rules on the chopping block, then we have to think about other ways to plan for our kids and our grandkids, because that same inheritance could then later trigger some capital gains tax as it's passed on. That's not law today, but it's exactly the types of rules changes that can happen. And this is why we want to talk about tax diversification and controlling the power of when. When do you pay those taxes? So we talked a lot about these different buckets. The tax now bucket, the tax later bucket, the tax-free bucket. Most people are overloaded in the tax later bucket, meaning they're not sure what that money's going to be taxed at down the road. The fix isn't really complicated, but it does take a plan. And the earlier you start diversifying, the more options you'll have. So one of the things I like to encourage people to do is to look at your portfolio, not just from the standpoint of growth, which a lot of advisors focus on, is that accumulation of wealth. Continue to accumulate, but also start to put together a tax strategy. Okay, one of the things that I feel is really important, and one of the things I tell all of our clients is your investment plan is only as good as the tax strategy that supports it. It doesn't matter how much money you make. If at the end of the day, half your money goes to the IRS and to the franchise tax board, we want to make sure you keep as much of your money in your pocket as possible. Okay, so if you'd like to see where your accounts sit across these three buckets, that's literally a conversation I have with listeners all the time. You can always reach out to us through our website, www.edgwealth.com. You can give me a call here at the office at 916-359-2750, or send me an email directly at ed@edgwealth.com. And that's pretty much the power of when today. So I'm Ed Gwinnell. This has been The Wealth Shepherd. Thank you for listening, and we will see you next time.